Hi there, this is Christian Dye from Latitude West Financial. It is January 2023, and this is our stock and real estate market report. I have Dara Fahy and Ryan Runte joining me, allowing us to get a good glimpse as to what is happening in the real estate market. So what I want to do is I want to dive right in, actually, and to quickly remind everyone that today's information is not to promote the buying or selling of any stocks or the buying or selling of any real estate. It is simply an educational report, and we highly recommend that you do your own due diligence if you were thinking of making a purchase. So I want to start with what is going on in the Vancouver real estate market. So home prices right now, the average home price in Vancouver is for all residential properties, 1.114, and that of course is including both detached and attached. This actually represents a 3.3% decrease over the last month. So all of our reporting is from December of 2022. So as we could see, we have a 1.8 million on the detached house, but last time the number was much higher. In townhouse, a little over $1 million, and the benchmark for the condos is about 713. So to give you a little bit of an idea about whether a market is balanced or not, so whenever sales to active listings is below a 12%, that tends to mean that prices are going down, and it is very much it's very much a buyer's market. When it's above 20, it's a little bit more of a seller's market. So if you look at the past 2 years, we've always been very, very high above the 20% mark. But as we got closer and closer to the end of 2022, it started to go back down. But then one of the things that you notice is that it started slowly to become a lot more of a balanced market in between our 12 and 20%. So right now, the average is about 17.5%. And what we want to do is we want to try to understand what's going on currently in today's market. And that's why we have, Ryan with us to help us to understand if we are thinking of buying or selling in Vancouver right now, what is happening like now in January. So Ryan, I'm going to turn it over to you to let us know, in your view, what's happening with sellers, what's happening in buyers, especially with the increasing in interest rates.
Sure. Yeah. Good morning. Yeah, it's interesting the last couple of weeks, and I think Dara just mentioned that too. There's been a bit of uptick in activity. I'm seeing more like in the 600 to 800,000 range, that there's more offers, because a lot of the places that we're trying to get into with buyers already have accepted offers. So I think part of that is buyers have probably factored in that the rates have increased and hopefully done their last increase for a while. So I think buyers have kind of said, okay, hopefully that's it. Let's jump into the market, and prices have eased off a bit. So whether or not that's going to be a temporary sort of rally or not, but it does seem the last couple of weeks have been busier.
Yeah. So like right now, would you say that the market is fairly slow because it's lopsided, because people are, sort of waiting on the sidelines? And who exactly are these people? Are they investors or are they buyers?
Yeah, I think from our end, we're seeing mostly first-time home buyers. We have probably 3 or 4 groups of first-time home buyers that are actively looking, and they were kind of on the sidelines, in the fall and actually really in the summertime. So I think a lot of them are just now jumping in because prices have eased off, and they've kind of factored in the rates are what they are. So that's what I'm seeing. The other side of it is just interesting from our office stats, looking at some of the sales. A lot of people on the investor side are going back to pre-sales and trying to jump in there where there's some opportunity, and then they don't have to close on these projects for 3 to 5 years. Because I'm seeing a lot of pre-sale deals being done recently as well.
So are these new pre-sales, or are these people who cannot complete on their pre-sale and someone else is coming in to take them over because they're getting a bit of a discount?
They're new pre-sales right now, but that's an interesting point. So new pre-sales right now, I'm seeing like in Brentwood area and then like Surrey Center. I'm seeing a lot of buyers, I guess, kind of banking on that, in 3 to 5 years that the rates will most likely have come down and, they're just paying their deposit for now. But that is interesting. The other side of it is there's a lot of pre-sales closing this year where people may have trouble qualifying. So there may be some assignments coming on the market that will end up being a good deal.
Got it. But is there anything completing right now with the big jump in the interest rate where people are, trying to get rid of because they can't complete themselves?
I haven't seen a lot of those. I'm on a couple of chats, realtor groups that have assignments. I've seen the odd one, but I haven't seen a lot yet. So that may not come into play yet. And I think some people have probably just worked that out. But probably with what the rates are right now, there will be more of those assignment ones where they can't complete coming onto market.
Ryan, what is your opinion of this? You and I have been working together for many years, also investing in real estate for many, like over a decade. And what we have found is that in Vancouver, we often see really, really craziness, like just mayhem, over asking, overbidding, not enough inventory. Whenever inventory does come on, there's all these multiple offers. And then we see these slowdowns like right now, where, it's almost like a bit of a ghost town. I wouldn't say it's a ghost town now, but it is a bit lower. But the thing that always shocks me is how quick it turns around, where it's literally like there's absolutely no supply. And if someone was to list, they'd have, 10 offers on it on the first day. And then 4 months later, it's, this person has to drop their price by 10% just to get any activity. Do you feel in 2023 there is that possibility where, for example, Bank of Canada decides to, hold their rate, not make it, or they say inflation is under 3%, all of a sudden there's a lot of market sentiment, then all of a sudden there's a chance we could have that craziness, and then people look back on the crystal ball and they said, man, if I would have known that, I totally would have bought a place, even as an investor, and I could have even flipped the place. Like, what do you think?
Yeah, it's quite possible, right? I mean, they haven't solved the supply issue or the right supply issue. So many cities like Vancouver, for example, is looking at increasing the zoning for up to 6 units on a detached lot, for example, which is pretty interesting. So they really haven't solved that supply issue. So yeah, I think if the rates don't go back up by, I think Dara said the next update is in March, then it's quite likely we're going to see an increase in the market. And then when the rates start to come down, which could be, into next year, then I think, yeah, we're going to see a busy market again. Because, yeah, there's quite a few buyers on the sidelines. That really hasn't changed. And the supply issue hasn't changed. So essentially, we're slower right now because of the rates and the rates being higher. So.
Yeah, you know what, whenever I gather this information and then whenever I look back at history, I always tend to agree. So, that's a great update right now. I believe that if someone had a fairly, good down payment or deposit, and you weren't as subject to the interest rate risk, and I'm talking like 40% down, 50% down, I do think that they would see a fairly good return. If there was something, because the fundamentals are still there. The Broadway corridor is going to complete, the Langley SkyTrain is going to complete, like all of those fundamentals are still there. Okay, thank you, Ryan.
Thank you.
That was wonderful. Okay, so now I want to shift to talk about the mortgages. It's probably one of the bigger things that we're talking about now. So I bring in Dara Fahy, and what is happening right now with mortgages? Dara, are you there?
I am. Good morning. Thanks for having me.
Yeah, okay. Tell me a little bit. Bank of Canada rate hike. Talk to me about what just recently happened.
Yeah, so we just had last Wednesday, the 25th, we had an increase of 0.25%, which was expected. This was a bit of a positive sign. It was the 8th increase in a row, which is not so positive. However, this is the first time they've backed off from their 0.5% and 0.75% hikes and just went with a 1/4% hike. The tone in the last two announcements has definitely changed. In the beginning, during those first 6 increases, they were very adamant that they were going to do whatever it took to get inflation low, and even if that meant a lot of pain for Canadians as borrowers and businesses. The tone in the last two has definitely shifted. They've kind of said now they're going to slow it down and take a bit of a wait and see approach. Things are trending in the right direction. Inflation's going down a bit, not as fast as they'd hoped. And they still want to see it return to 2 to 3% range, but at least they're gonna kind of wait and see how things play out and let these increases take their effect on the market.
Sure. And then so right now, right now, what has happened is it seems that the rates went up really, really quickly, really, really fast. But from when we last spoke in December, it seems that there's been a minor pullback on the 5-year fixed. Can you tell me about that a little bit?
Yeah, that's absolutely correct, Christian. So, the bond yields are, we've talked about this many times, the bond yields are what dictate the fixed rates. And they tend to move in advance of what the Bank of Canada is doing, which affects the variable rates. So during that run up from last March, when there was a lot of aggressive increases by the Bank of Canada, we saw the fixed rates really jump in advance of that, basically pricing that in and telling us what's going to happen. Now we're starting to see the reverse of that. We're starting to see the 3, 4, and 5-year fixed really take a dive. Currently, the 1 and 2 year fixed rates are the highest. So we've seen this shift indicating to us that the Bank of Canada is expecting this to play out that way, and that we're going to see, possibly one more mild increase in March. We're going to see it level off from there, and over the next 3 to 5 years, we're going to see rates come down quite a bit.
So, there is another potential rate increase this coming year. When is that?
The next one is scheduled for March 8th. If I had to make a prediction, I think there's about a 50% chance we get another increase, and if we do, it's going to be mild. It'll be another 0.25. So there's a reasonable chance we get that. There's also a reasonable chance we don't, and they just start to back off and watch. So I think if we do get one there, that's our last for the year. Many economists that we follow do believe we could start to see some decreases towards the end of this year or early next. So there is some relief in sight. I don't think those will necessarily be drastic, unless we're really heading towards a deep recession, which is probably a small possibility. But assuming not, I think we just start to see them mostly stand pat for the next 12 months and possibly some mild decreases.
Got it. And you feel that this leveling off will occur once inflation is under control and their target is under 3%. That's correct?
Yeah, correct. I mean, I think for them in a perfect world, inflation is at 2% level, but definitely, I think, at 3% and below is where we can start to see them really back off and possibly make some cuts.
Right now on the mortgage side with the guys who are the activity that you're seeing, is it mostly buyers who are investors or buyers who are first-time home buyers or people upgrading? What are you seeing with the guys that you're dealing with?
You know what? We're seeing a lot of first-time buyers coming back to the market. We've actually been quite busy in January. August till December was pretty quiet, and there wasn't a lot of activity. We've seen quite an uptick in pre-approvals and people wanting us to hold rates in January. So it's been busy again. As Ryan mentioned, we've actually had we've seen some increased activity in the market too. We've had clients lose out on some offer situations in the past week, which was interesting to see. Hadn't seen that in a while. So yeah, I'd say overall we're getting quite busy, and I would say it's mostly first-time buyers, people upgrading, not so much investors. There's definitely some, but I think primarily I would say it's people looking for new homes.
Got it. All right. Hey, thank you. And just a reminder, if anyone did have a question, we're going to field them at the end. You could just put them in the chat. So I've always said, if you are thinking of buying, get pre-qualified, just because, of course, you will get the lower rate, whether it goes up or down. So what I want to kind of address, and of course, me with clients, if anybody is looking for an investment in Canadian real estate, getting pre-qualified, remember, Canadian, once you're pre-qualified, then the mortgage can go anywhere. It can go in Alberta, Saskatchewan, Manitoba. But if you're looking for an investment property where to park money, especially with the volatile stock market, then we really should probably talk, just because there are, believe it or not, good real estate opportunities, but they might not necessarily be in BC. So with clients, we do work with them looking at other properties. This was a house that we helped the client with. It's out of province. It was only $450,000, but the cap rate, the cash flow, and the internal rate of return were all very, very, very strong. Right now, there are still places, and sometimes you got to get creative. Like, one creative way is to go out of province. Another creative way is to see how, with the high interest rates, how we can get more rental to cover it. So we're working with realtors cross country who have really good Airbnb options for us. And again, even off of a 20% down payment, we are seeing that there is some cash flow, as well as strong numbers on the cap rate and the IRR. I invite my clients who are listening, or I invite any potential clients who are listening to connect with us. This is one of the value-added services that we are able to do, and that is to explore investment real estate outside of your own backyard. So what I'd like to now do is shift gears a little bit to talk about what's happening in the stock market now and what's going to happen in 2023. And what I do is I rely very, very heavily on information. I rely on a gathering of what is the economist saying, which direction are the markets going. So that helps me to be able to better inform the existing clients, as well as to better perform our portfolios going forward. So the S&P earnings is expected to be low in 2023, and they often will look at several factors. One factor is, of course, is manufacturing. If you'll notice, manufacturing PMI is directly correlated to the S&P. So the year over year right now prediction is that it will remain slow. It will remain slow. So is a recession coming in 2023? So I reported this last month as well. There was a survey of, I think, over 500 CEOs. 98% of them believe that a recession is coming in 2023, according to the chief economist of the Conference Board. But most of them also agree that if there is a recession, it will be mild, or short and shallow is the words that they use. Okay, they believe that the reason for the recession will highly be because of the rising interest rates and the slowdown in things such as housing. So in the recent report that was given here in January, there are multiple signs that signal a recession. And if you'll notice, of these signs, we have several of them that are now in the yes category. So the inverted yield curve is a yes, positive inflationary trends, and leading economic indicators are negative. Now, other ones are still in the negative, sort of the neutral standpoint, and only one of them is in the no. So right now, sentiment is that we're either in a recession or we're heading for a recession in 2023, and that does not mean a strong outlook for the stock market. However, I'd like to point out a couple of things, okay? And I'm a big data gatherer here. Does that mean you should not be investing in the market? And I believe the answer is no. That is not what I'm saying. So let's just go off of some historical data. So table of returns in recession pre and post since 1970. So pre is what was the S&P 500 2 years, 1 year prior to a recession? And if we'll notice here, we have an 8.3, and we have a 5.5% rate of return. Now, during the recessionary period, how far did the S&P go? And on average, it went down about negative 7.7. If you took a look at the peak down to the trough, so the highest down to the lowest, it was on average 36%. But from the trough to the 1 year, forward, it bounces back. So what happens on average from recessionary times, on average plus 1 year, and we notice we're back in positive gains, 8.8, and 2 years, 6.2. Now, do we know exactly when we're ever going to be at the exact bottom of the trough? We don't. We don't know. So if we did, of course, we would put all our money at that exact bottom. But what we do know is we're hovering in this sort of lower area. So what my sentiment would be, fairly boring, and that's stay the course. Don't pull money out, still keep investing. I think that the whole point is that for dollar cost averaging, the whole point is that sometimes you're picking, the market up when it's low, and sometimes you're picking up when it's high, but overall, it smooths out and you usually get a decent return. Now, one of the other things that we should always look forward to, and then this one over here sort of shows how historical returns 1 year forward, and as if you'll notice here, they are in a positive area. So Morgan Stanley right now, they said that in December 1st, 2021 was about the peak of the S&P 500, and it was at 4,700. Last time that I gave this report, we were in the high 3,000s. As of just recently, which is when I did this pretty much about a day ago, it was around 4,009. So what we do notice is that we are still down from the peak, absolutely. Morgan Stanley believes that in 2023, their bull case is 4,200. So you notice it's not very high. They don't believe we're going to get back to the peak that we had before. The base case is going to hover around that 3,900, 4,000 area. And the worst case is that it'll go down to the 3,600. So another market strategist believes that there is going to be a mild recession predicted, and that will end again, is consistent with their other message, at around 4,200, which is, it's slow growth. It's very, very slow growth. It doesn't mean to start pulling money out, though, I don't believe. Okay. So here is the volatility of what we found in the last, looks like 15 years. So what we notice is that if you just stayed in the markets, you're going to get somewhere around an 8% return. But the problem is going to be the standard deviation. Can you handle all that volatility? So the average standard deviation is about 16.5%. So if you'll notice, the market was down 24% in October, 17% in November, and in January, it's about 14%. So what's one thing we notice? At least it's trending in the right direction. That's positive news. But I do think it's going to be a bumpy ride. I do like right now, it just in the last week, it's gone up significantly. It is going to be a very bumpy ride, because whenever information hits the news, the markets tend to react. So what do we do here? For those of you who aren't investing with us, those who are investing with us, of course, know what our philosophy is, and we like stock exposure, but not stock reliance. We do not like all of this volatility. We get our philosophy from large institutions such as the Tiger 21, as well as the Canada Pension Plan. And these guys get really, really solid returns. So the Canada Pension Plan has outperformed the S&P 500 by over 56% over the last 5 years. And one of the reasons why is because their allocation mix, and it is very similar to our allocation mix. And our philosophy has been, you should only have stock exposure, not stock reliance. So if we look at the Tiger 21, over 31% of their assets is in real estate. Now, that might be made up of passive and active real estate. And they have an incredibly large portion in fixed income. And the reason why the majority of people don't have that much in fixed income is because then the returns are quite low. But we often have our real estate pulling us up. our stock portfolio keeping us stable, and our fixed income ready to pounce when we're able to see an opportunity. So just to give you an idea of some of our investments with our clients in our portfolio. So our core portfolio, you've noticed, it's got that 31% exposure. We did not see any negativity, any significant negativity in 2022. So we ended at 6.1% on the end of the year. And as of January, we're up 7.5 over the past year, whereas the stock market, as I remind you, is down 14. We're up 7.5 on our core portfolio. Now, if you look at our private investments, our private portfolio, and this is the things that people cannot find on their own in their Quest Trade or in their own personal accounts. We ended the year up 11%, and the average for the last 10 years has been about 13. So these are RSP and TFSA eligible with our private investments. So for those of you who can't stand the volatility of the markets, or you're looking for some safer places to park things, and you're not already investing, then you probably should give us a call, and we'll set up a time and we'll go over this. So should you be using an advisor? And the quick answer is absolutely. I think there are multiple advantages and opportunities going on in the markets, but sometimes you just need to be with the right advisor to find them. So our philosophy has always been lower volatility without giving up returns. So we like to keep the volatility quite low. We like stable returns. We don't like to see negative or too much in the negative. So we like to capture a majority of the upside, but not be damaged so much by the downside. If there's any questions, now would be an appropriate time to put them in over here. And while you are formulating your question, I want you to remind you of our process, which is we always start with a complimentary discovery meeting. We try to figure out what your needs are and what you're trying to do. And then if we are moving forward, then we'll navigate a plan for you with our team. So our business model has always been not only traditional insurance and investments, but we are very, very pro on planning, as well as real estate investing and real estate planning. So if you want to connect with myself to further our conversation, we could do that through assistant at latitude-west.ca. We can, if you needed to connect with Dara, then we would go with Dara at citywidemortgage.ca. And if you want to connect with Ryan, Ryan at rwrealestate.ca. So once again, if there are any questions, please feel free to put it in the chat. Dara, are you still with us over there?
Still here, yes.
Dara, I had a question for you, actually. And my question was, if the 5-year fixed rate, which you said is around 5.09, is lower than the variable rate, which is at 6.4-ish, that would mean that the banks are almost projecting that they believe with great confidence, if they're about to lock someone in at a 5%, that basically the prime rate will be going down over the next 5 years. Would you say that that's correct?
I would say that is absolutely correct. Yeah, it's basically forecasting that we're going to see decreases as early as, say, 12 to 24 months from now, because as I mentioned, those are the highest rates.
So now comes the $1 million question here, Dara, and I'm not sure how comfortable you are saying this in this recording, but if someone was to come to you right now and they said, well, you're predicting that the variable rate is going to slowly go down, and I am about to lock in and I'm about to get a mortgage, would you advise them to do a variable, or would you advise them to do a fixed?
I don't think there's a right or wrong answer to that, and it depends on one's risk tolerance. I believe a variable is still a good play, and I think I'm actually variable myself. Mind you, I've been variable for many years. So when you're playing the variable, you want to play a bit of the long game and expect to win on average over time. And there's going to be some great periods and there's going to be some painful periods. So I do still like the variable if one can A, withstand the risk, and B, they're patient enough to ride through these times. That said, I mentioned I'm variable and sticking with it because I have been for many years. If I was getting a brand new mortgage myself right now, And what I'm guiding clients to do right now is to look at a short-term fixed, either a 1 or 2 years. They're going to pay a bit of a premium, but if they're on a tight budget and can't withstand more increases, which we could get, and we have to remember, maybe there's a black swan event, like more war or something like that, that causes a spike we're not expecting. If the last 3 years of COVID and now this inflation have taught us anything, we don't know what's going to happen. So I think if one can't withstand that risk, I really like the short-term fix because they get that certainty on their payments for the next 1 to 2 years, even 3. But they have that flexibility to pivot out if the rates do go down like we expect. So I would say short-term fixed, definitely not more than 3 years.
Excellent. Hey, that is a fantastic piece of advice. Like I said, if you wanted some expert opinions on mortgages or on the real estate, please feel free to connect with us. So I'm going to wrap it up there. Thank you very much, gentlemen. Until next time, I hope everyone stays safe, and let's see what happens next with this real estate market. And thank you, everyone, for joining. And if you're listening to if you are listening to our recorded talk, by all means, we still invite you to connect with us. All right. Have a great rest of the day.
Thanks, Christian.